Over recent years, the ability to trade the financial markets from home has become so accessible. Technically, you can get started with as little as £250 and zero knowledge of how to trade or invest. This is the scary thought, but unfortunately, many new investors go down this route and they opt for day trading as they believe this is the route to quick riches. Unfortunately, successfully trading the financial markets is not as easy as that. In this video, my aim is to explain the different styles available for retail traders and investors, and I'll give the advantages and disadvantages of each and my personal recommendation. Day trading is a style of trading that you'll see most traders promoting on social media. It is portrayed to be an easy and quick way to replace your full-time employment. Unfortunately, this is not the case in reality. Day trading is a style of retail trading where your aim is to enter and exit multiple trades per day, hoping to profit from price movement in whichever market it is you are trading. As a day trader, you'll likely have a handful of foreign exchange pairs or a mixture of other markets that you trade, which might include stock indices, some popular stocks, or commodities such as gold. As a day trader, you'll be trading from low time frame price charts, such as the 60-minute, the 30-minute, or the 15-minute time frame. These low time frames will enable you to enter and exit trades multiple times per day. Your trades will have a set stop loss and take profit target, preferably with a favourable risk to reward ratio. Most new traders opt for day trading because they think that being in and out of multiple trades per day is how to make the most money. This isn't necessarily true, as I'll explain with the other methods I'll mention in this video. However, day trading is advantageous to those who want to be as active as possible in the markets. Day trading is for those that have a passion for the process and the intricacies of the markets. People that love executing trades and enjoy the thrill of day trading because it gives them more screen time. Besides the money, trading full-time can bring with it time freedom. Not having a 9-to-5 job and living your life by your own design is a huge factor to those wanting to learn to trade. However, day trading is a very time-consuming style of trading because it is based off intraday timeframes. Although yes, you're working from home and you're your own boss, but trading can be far more passive than this. The other main disadvantage to day trading compared to other styles is the stress and precision of execution it involves. Because day trading is short-term in nature, timing and precision is far more important compared with longer-term trading. You're dealing with more noise and volatile short-term price moves. This leads to larger fluctuations and volatility in your profit and loss, and therefore more stress and less margin for error. Swing trading is longer term than day trading. This style of trading will likely be based off the 4-hour or the daily time frame price charts. Generally, a swing trader will hold trades for a few days to a few weeks. The idea is to capture larger swings in price movement. Swing trading strategies can be applicable in wide consolidating markets, the aim being to capture price movements between the highs and lows of the range based on support and resistance. Swing trading can also be used in trends. Rather than capturing whole trends, with swing trading you'll likely profit from swings in price movement between lower highs and higher highs within a larger bullish trend. Swing trading will give you more time freedom as a trader compared to day trading. If you're trading from the daily time frames, then realistically you only need to manage or execute trades once per day. This frees up your time to do what you want. Of course, if you prefer to execute trades from lower time frames, then more time commitment might be necessary. Longer term investing is another viable method of investing and is popular among those people that do not have an interest in learning about technical analysis or moving in and out of markets. Long-term buy and hold investing can be centered around either companies that pay good dividends, which is a share of the company's profits given to its shareholders, usually on a quarterly basis, or value investing, which is more focused around buying companies that have more growth potential. Growth potential is looking towards more capital gains over time, whereas dividends offer more cash flow through quarterly payouts. Buy and hold investing is by far the more passive method, but the flip side of that is that the returns will be lower than the other methods. With buy and hold investing, you can expect to match the overall market, say the S&P 500 index if you're investing in US stocks. But with the shorter time frame trading methods, you can expect to outperform these indices. The risks involved with long-term investing are usually lower because share dealing accounts do not offer leverage from the broker. As with day trading, swing trading and trend following, we typically use leveraged accounts, meaning we can borrow money from the broker to buy our investments. This means we can simply buy more than we would have been able to, or we can use some of our capital elsewhere. Leverage can be a double-edged sword though. Yes, it does enable us to have more buying power, but if our investments are moving against us, then we can end up with more losses than we anticipated. Leveraged accounts must only be used by traders that have a sound understanding of risk management, position sizing and stop loss use. Trend trading or trend following is far longer term than day trading. It lies somewhere in the middle between swing trading and buy and hold investing. With trend following, entries will be taken from daily timeframes. However, weekly, monthly and even yearly timeframes will be used for technical analysis. Trends in the markets can last for months if not years at a time. The aim of trend trading is to enter a trend close to its beginning. After entering, you'll use a trailing stop loss, as opposed to a fixed profit target that day traders might use, to follow price as it makes new higher highs and higher lows within that trend. This stop loss will be wide enough to cater for normal sized pullbacks within the trend. Rather than only trading a handful of instruments, as a trend trader, you'll scan across multiple asset classes to find the best long-term trends. This will include stocks, commodities and forex. A lot of traders wonder how you can make substantial returns from trading such a relatively slow and long-term strategy. The answer to that is through compounding, which is a technique of adding positions to your portfolio while keeping your risk low. This is similar to scaling in or dollar cost averaging in the investing space. Also, with trend following, your stop losses and position sizing is so much wider than day trading or swing trading. This means you can get away with having slightly more risk on the table in comparison. Trend following is my preferred method because it is far more passive than day trading, but you can achieve higher results than buy and hold investing. It requires about 10 to 15 minutes of my time per day, Monday to Friday. I then spend a maximum of 2 hours at the weekend doing more in-depth analysis ready for the week ahead. This means my whole trading week takes me less than 4 hours. A typical day trader, on the other hand, would likely spend at least 4 hours per day in front of their trading desk. Through the power of compounding and trading multiple trends at once, the returns possible with trend following will be at least that of day trading, if not more. Trend following is far slower and less volatile than day trading, meaning it's far less stressful and a healthier way to trade. Trend trading generally isn't popular among newer traders. I believe this because, as already mentioned, day trading is portrayed as an easy get-rich-quick scheme. On the other hand, trend trading requires more patience to materialise any sort of profit. Traders are put off because they don't believe significant returns can be seen with such a slow style of trading. Also worth noting is the 5 to 10% success rate of day trading. This suggests it really isn't as easy as most gurus make out. Failure is partly because when the naive trader realises it's not as easy as it's made out to be, they either give up, lose all their money, or bounce from strategy to strategy, not getting anywhere. The right mindset from the get-go, a good mentor, and investment in your time is what will set the foundations for a long and lucrative career investing the financial markets. If you enjoyed this video, please like it and subscribe to Subconscious Theory for more content.